Welcome to Global Insights with me, Punita Kumar Sinha. Today we analyze BRICS, a group of fast-growing economies that account for 40% of the global population and nearly a quarter of the world's GDP. A few years ago, a report by Goldman Sachs predicted that Brazil, Russia, India and China were the economies that would drive the world in the future and that these countries would account for 40% of the world's GDP by 2050. Are the BRIC economies still likely to grow strongly? Will that get reflected in their equity market returns? Richard Titherington of JP Morgan Asset Management and Arvind Subramanian of the Peterson Institute for International Economics will join me to talk about that. But first, let's see how things are in the BRICS economy. Nikhil Shivadas has this report.
Picture perfect. That's what the BRIC story seemed like a few years ago. But the global financial crisis has cast a dark cloud on Brazil, Russia, India and China and taken a toll on everything from external trade and finance to investor confidence.
I think that BRICS has been a great tagline for a certain investment bank that we all know about, but I don't really think that it's actually added a great deal of value when it comes to understanding where the best investment possibilities are.
While the power of these economies cannot be written off just yet, there are telltale signs that the excitement about them may be overrated. According to CME Economic Research, the real GDP of BRIC nations is falling. From 8.1% in 2010, it's expected to be below 5% in 2012. But that's not to say it's gloom and doom all the way.
I think the basis of any equity market allocation really is on the fact that whether these countries are growing their income per capita and whether they're doing it through productivity gains. If that's the case, then those countries tend to be much more of a better opportunity for emerging market investors.
Even so, there is reason to worry. China is struggling with a slower import demand from Europe and the US and a slowdown in construction which contributes to over 20% of its GDP. And even though Russia is riding high on oil, it has reasons to worry because the Eurozone accounts for more than 50% of its trade and the European Union accounts for 75% of its FDI. Brazil is grappling with falling domestic consumption and India is struggling with high inflation and a policy deadlock resulting in slower growth.
If the government failed to address the fiscal issues and also the macroeconomic growth rate remains low, not limiting to this fiscal year but next fiscal year as well, and then there is a greater possibility for us to downgrade India's BBB minus sovereign ratings.
According to EPFR, last year, global investors withdrew nearly $15 billion, or about a quarter of the money they invested in BRIC nations over the past decade. And that is making many wonder whether this story is still worth buying into.
I think it's going to be a lot more about picking the really good industry structures, the very good management teams, and not paying too high a price, because that's where those returns are going to be.
It's also not going to be easy for BRIC nations to keep investors hooked, because another group of emerging economies, or the next 11, is now finding favor with investors.
That group are doing really well this year, despite all the fear people have. Those markets, or that index, is up close to 15% year to date. And I think it's partly because they're not as big as the BRIC markets, so they're not so correlated with risk on, risk off.
The challenge for BRIC nations now is to get a grip on growth once again and prove their believers right.
Joining me today are Richard Titherington, Managing Director and Chief Investment Officer of JP Morgan's Emerging Markets Equity Team, and Arvind Subramanian, Senior Fellow, Peterson Institute for International Economics. Together they have decades of experience with emerging market economies and policies. Arvind, let me start with you. Data suggests that BRICS have increased their share of global GDP threefold in the past 15 years.
Right.
How much will the BRICS share of global GDP increase over the next decade?
I think, of course, that depends very much on whether you measure it in, dollar terms or in PPP terms. But I think, regardless, over the next 10 years, the BRICS share of world GDP will go up. In market terms, it's about 18% of GDP. That will go up to about 25, 26% over the next 20 years, and even to about 1/3 by 2030. And in PPP terms, it's about 30% of world GDP at the moment. By 2020, it will be about 37, 38, and going up to as much as 45 by about 2030. So that's a big shift.
In your book Eclipse, you have talked about the fact that China is going to become even more dominant in the next 10 years.
Right.
Currently, 2/3 of the BRICS is already exposed to China. Going forward, do you think China is going to remain 2/3 of the BRICS? And then what will happen to the other BRICS?
I mean, the short answer to, where the other BRICS are going to be in this whole kind of big picture dominance game, the answer is nowhere. And I think the only country that has a chance of kind of catching up with China in this broader sense is in fact India. Because, Russia and Brazil just do not have the demographic weight that India and China have. So in fact, when I do these calculations, over the next 20 years, Brazil and Russia figure nowhere in the top 5, 6, 7, 8 countries. But India, in fact, by 2030 becomes the world's third most economically dominant country, the way I measure dominance. And the reason for that, of course, is that, going forward, one would normally expect that India will grow faster than China, just by virtue of the fact that India is actually poorer now than China. So what China accomplished over the last 20, 30 years, with the appropriate conditions, India should be able to do going forward.
That's interesting. Now, Richard, coming to you, the concept of BRICS seems more of an economic concept. Do you think it can translate into equity market returns?
Well, I think that although the BRIC countries have been identified because of their economic importance, I think the financial market returns go alongside that. And if you look back over the last 5 or 10 years, the returns that you've got from investing in the BRIC countries have been significantly higher than they have been investing in developed markets. And I think although I expect equity markets to be volatile going forward, I think long-term returns from the BRIC countries, both in economic and stock market terms, are going to remain good.
But the BRICS haven't really outperformed the other emerging markets, have they?
They haven't well, it depends what time period you want to start from. I mean, obviously you can pick different time periods. Over the more recent times, the BRIC countries have underperformed. I think that in the run-up to the financial crisis, when you got to the 2007, maybe there was too much emphasis on the BRIC countries. And I certainly think that investors in emerging markets should look more broadly than just investing in the big four, because in many of the other countries, Korea is probably quite a good example of this, there are many companies there that benefit from the economic growth story of the big four BRIC countries.
Arvind, you've developed an index to rank countries by different economic indicators. I want to talk to you about how BRICS nations fare in that index. But first, let's take a short break. Stay with us. Welcome back. You're watching Global Insights with me, Punita Kumar Sinha. And I am in conversation with Richard Tutherington of JP Morgan Asset Management and Arvind Subramanian of the Peterson Institute for International Economics on where they think the BRICS nations are headed. Now, Arvind, you have derived an index of economic dominance that includes GDP, trade, and creditor-debtor status. So when will India's turn come to be the dominant country in the BRICS?
I think by 2030, India will be nipping at the heels of China. And hopefully 10, 15 years later, I think India will catch up. But I think in GDP terms, India will eventually have to catch up, right? Populations will be broadly similar. Maybe India will be slightly ahead. And at some stage, our levels of GDP will also be the same, assuming India catches up, over the next 15, 20 years. But remember that India will never be as open a country as China has been. India is a relatively closed economy, and India will never have the external financial strength that China has had. Because remember, China has been accumulating reserves based on running surpluses. India is a deficit country on the external side, so we will always be vulnerable on that score. So in the dominance stakes, I think India will come close to, but never really catch up with China.
Arvind, now moving on to exports and currencies. Two of the countries in BRIC are exporters of commodities, that is Brazil and Russia, and two of them are importers, India and China. Do you see that as a big threat for India and China long term?
Okay, so I think that's a really good question, Punita. But, if I were giving that answer to you a year ago, my answer would be very different. And my answer today is the following, that being a net importer of commodities, especially energy, I think is no longer a big vulnerability. I think a kind of a seismic revolution that's occurred in the international economic landscape is the discovery of gas, and so energy is becoming more plentiful. So being an importer, I think, is not now a big vulnerability, because there's oil, there's gas, it's going to be cheaper, and I think that landscape has changed. I think where India and China are very vulnerable, which is why I think your question is a very good one, is in terms maybe of land and especially water. That means being a net importer of agricultural commodities could be a potential vulnerability going forward, because I think especially if you believe that global warming is going to happen and the Himalayan glacier is going to kind of dry up, then water scarcity might loom much larger as a constraint for both India and China.
Amongst the 4 BRIC economies, only Brazil is self-sufficient in food. Isn't that inflationary for the other BRIC economies long term?
See, I think, again, that calculation depends upon, I think, the following. I think if you look at global agriculture, we can certainly see some significant negative supply shocks to the global economy. One is, of course, global warming. So the question is, given the rapid pace of demand from poorer countries and the increased demand for agricultural commodities, can there be other, positive supply shocks like technological development that can offset the negative supply shocks that are going to come from water and climate change? So I think that's a big open question. And unless we see some, major technological, kind of revolution going forward, it could be GMOs, genetically modified stuff, unless we see that happening, then we could see, some problems, in global agriculture, which would mean that India and China would be more vulnerable than, say, Brazil.
Now, Richard, the same question to you. 2 of the markets, Brazil and Russia, are beneficiaries of rising commodity prices, and India and China are negatively impacted. How do you factor that in while building your emerging market portfolio today and in the future?
Well, I think that alongside diversification, you want to be balanced, and I'm a great believer in focusing investment on things that you think you can predict and things that you can understand, hence wanting to invest in rising domestic consumption. I don't think that commodity prices are particularly easy to predict. So when managing a